Hello, everyone. This is Ted Bauman here, editor of Bauman Daily, of the Bauman Letter, and of Profit Switch. As you can see, I'm not in my usual digs today. I'm actually up on the banks of the Rappahannock River, visiting some relatives, and I'll be back in Atlanta next week. Today, I want to talk about what's going on in the markets, and that is today, this being Thursday, since I record the day before I release the video. We saw the reaction to the Federal Reserve's committee meeting yesterday, the Open Market Committee, and it has caused a predictable reaction, as such meetings tend to do, but it's really going in the opposite direction of what a lot of people tend to assume. Now, I think there's a reason for that, and that's what I want to talk about today and what it means for the longer-term perspective. The first thing to note is that really the only thing the Fed said that's any different from what it's been saying for a long time is that it may be that inflation is going to be higher than they had initially expected, but in any case, they don't see any necessary steps that they need to take right now, except perhaps that they will raise interest rates in 2023 as opposed to 2024. Now, remember that that is simply an expression of some of the members of the committee on the so-called dot plot, which shows when they think interest rate increases might happen. It's not a formal position of the Federal Reserve by any means. It's just that some Fed governors seem to think that we might end up needing to raise interest rates more than 2 years from now. Now, what is the logic behind that in normal circumstances? Well, normally, if you saw the Fed saying that they were going to be raising interest rates, even if it's far off in the future, you would expect that bond yields would rise because people would want to sell them because they wouldn't want to be locked into lower rates if inflation were going to rise and if interest rates were going to rise in the future. The second thing you would expect is that growth stocks would take a hit because, again, higher interest rates and higher inflation are not good for growth stocks for reasons which I've discussed many times. The third thing that you'd expect to see perhaps is a turn to value, a turn to real world, real economy stocks, and that people would want to end up buying those stocks because they would think that, well, if the Fed thinks it's going to be necessary to raise interest rates, that means that they think that the economy is going to be stronger by 2023. So let's buy stocks in companies that produce raw materials like copper or platinum or that make useful things, the kinds of companies that I've been talking about since the beginning of this year. Instead, the exact opposite of all that happened. Bond yields actually fell, which means that people were buying bonds. They fell strongest in the 30-year bond and the 10-year treasury, and growth stocks rebounded today. We've seen big jumps, particularly in the renewable sector and in some of the technology stocks that have been beaten back this year. And the third thing we've seen is a big fall, particularly in the values of commodity producers, particularly like in copper and platinum and other industrial metals, as I mentioned. Now, again, this is all precisely the opposite of what you would normally expect. So what's going on here? Well, I think the key thing here is that people are putting a great deal of store in what happens with interest rates. In other words, they are gambling that interest rates are going to be going up, and that means that they essentially that's going to make the economy grow more slowly. Okay, that's the critical impact that they're seeing. They're thinking, okay, the Fed is starting to talking about raising interest rates. That means that economic growth is going to be squeezed back. That means that we won't get the big gains in commodities and real world value stocks that we thought we were going to get. So let's sell those. But let's pile into growth stocks because they're the only action. They're the ones who have seen big declines in price recently, and so therefore that's where we think we can get some action. In terms of the bond market, it's even more difficult to understand, but essentially I think what's going on is that people are actually moving to safety in the form of bonds, even though those bonds might not be worth as much in 2023 if interest rates do go up. So I think there's a logic behind it, but to me, that logic suggests something fundamentally problematic about the current stock market situation. And that is that people are trading more and more on a very limited set of data about one thing, and that is interest rates, where interest rates are likely to go. And they're assuming that interest rates are going to be the overriding factor driving the condition of the economy in 2 or 3 years from now. I think that's absolute nonsense. I think that right now, the key drivers of the economy, as I've been saying, are sorry, I'm not going to say fundamentally again. Somebody reminded me about that. Are basically about government policy. And the big issue here is really about whether the Democrats are going to be able to pass any further major spending bills given the political situation within their own caucus in the Senate. And that really calls into question the government's ability to pump more money into the economy in the form of whatever spending, but infrastructure spending. We've already seen a disappointing unemployment report today. We saw higher than usual claims. We've seen a slowdown in retail growth. And all of that runs counter to this inflation narrative that we've been seeing. And yet, the stock market seems to have reacted primarily to the idea that there would be higher interest rates by punishing companies that would benefit from higher growth. I think it's essentially we're getting to the point where people are starting to doubt the narrative about rapid economic recovery from the pandemic. I think what's happening here is that the stock market has become more and more convinced that the narrative was overblown. And that it's starting to think about retreating back to the growth stock, which is really a speculative approach based on cheap money and based on low interest rates now. So in a sense, it makes sense if you think of the stock market more in terms of a current speculative gambling approach to stocks as opposed to long-term positioning. Because the long-term positioning, to me, still suggests that we are going to see a lot of demand for basic things like commodities, industrial supply, and things like that. And we know we have big shortages in things like microprocessors, shortages of things like copper and lumber. And yet the market is punishing those things. And I think it's doing it prematurely and it's doing it erroneously. It's a very, very knee-jerk reaction. Now, what's the best plan to trade through this whole thing? Well, first of all, I wouldn't trade on the basis of anything that comes out within the first 24 or even 48 hours after a meeting like this. We've become so focused on what the Federal Reserve does. We've become so totally consumed with the idea that everything revolves around the Fed and its interest rates that we've forgotten that ultimately what drives profits over the long term or drives the stock market over the long term is actual profits. If going back to a stance that says that growth stocks are the way to go because we're not going to see this explosion of big growth and essentially contradicting the Fed's own statements about what it might do in the future, that suggests to me that people are taking a very short-term, very narrow view of what's going to happen. And in those kind of circumstances, you don't want to make any trades that you could come to regret as people realize that they might have made a mistake. Now, there's also other factors to concern. Tomorrow, Friday, is a quadruple witching day, which is always a big day of big movements in the market. So that could have something to do with it. My colleague Clint Lee suggests that perhaps bad news around one of the mRNA vaccines that proved not to be very effective might have also spooked people into believing that there could be more lockdowns. Personally, I don't think that's likely to have been a major factor, given that Pfizer and Moderna both work very well against these Indian variants and so on. So fundamentally, I think what we're seeing here is a short-term reaction that is really based on a counterintuitive understanding of what the Fed and its actions might do in the future. I still think there's a good possibility that we could see some significant spending out of Washington. It may not be everything that everybody wanted, particularly in the renewable side of things. But nevertheless, if that happens, and of course the Democrats have a massive incentive to do it if they want to stay in office or in power after next year, then that will essentially boost the economy. Yes, it will probably lead to higher interest rates, but who cares? Right now, interest rates are between 0 and 0.25%. That's the Fed's target rate. They're thinking about raising them to 0.6%. 0.6%, folks. That's not very much, all right? So I think we're over-privileging interest rates in this environment, and what we really need to do is to go back to the fundamentals. And I know there are a lot of people who disagree with me, that I'm an old hat fundamentalist, they say, but I'm still convinced that there's a lot of gains to be made by doubling down on the real economy stocks, the stocks that are going to involve resource extraction, home construction, all those things over the next 3 to 4 years. There just isn't that much higher for growth stocks to go in terms of price to earnings ratios. Having said that, I do think there's a lot of opportunity in the renewable sector. We saw a big jump in renewables today, and I think that's because That's the part of the growth sector or the growth stock sector of the stock market that is most amenable, most logical, because it is a real secular growth market. It's not just hype. It's not just companies, putting out SPACs. It's actual companies operating in a sector that has big secular tailwinds behind it. So, two things I would do. One is I would continue to bet on commodity stocks. I'd buy the dip on them. The second thing I would do is reconsider, maybe pulling into some of the renewables that you might have sold off earlier this year at high profits. I know at Profit Switch, we did that. We sold a lot of our renewable energy stocks more or less at their top back in December last year. We captured some huge gains, and since then, the ones that we've held on to have gone down a bit. Now might be the time to get back in before they start rising again, because the logic or the illogic of the situation suggests that that's the one kind of Goldilocks spot in the stock market right now. I may be proved wrong in the future. Nobody has a crystal ball, but that's the way I read things. Anyway, this is Ted Bauman signing off. I will talk to you again next week.